Pick up the cocksucking phone.
Sorry. and see some growth. But this is troubling on a Friday. No liquidity in the markets. And so that's why I actually think it's an opportunity to pick off some great names.
Yeah, no doubt, certainly seeing some kind of air pocket type activity. Let's bring into the conversation now David Rosenberg, chief economist and strategist at Gluskin Sheff. Dave, obviously you've been kind of on recession watch for a while right now. We have this general impression out there that, well, the rest of the world's slowing sharply. The bond market is flashing yellow, at least, in terms of a deeper slowdown. But the U.S. data has held up okay. We actually saw some examples of that this week. So where do you think this is all headed with regard to the U.S. growth picture and whether the Fed can do anything to support it at this point?
Well, there's a lot of questions there. I think that we're having a spreading recession globally. I think it's already started in the UK and Germany and Hong Kong. China's cooled off dramatically. And although the U.S. is largely a closed economy, it's not totally closed, and it's not an island of prosperity to its own. So there's going to be lagged effects here from the rest of the world on exports, and you're seeing it in manufacturing. I mean, industrial manufacturing production in the United States is down at a 2% annual rate so far this year. We saw the negative CapEx print on the second quarter, and housing is really, you saw with the new home sales today, even with lower interest rates, housing is not going anywhere. What's keeping the glue together, as you said, is the U.S. consumer. There's no doubt about it. The U.S. consumer has shown up, but will continue to show up, because the one statistic that has me a little unnerved is what's happening with real average weekly earnings out of the payroll report. Year over year, it's down to plus 0.8%. We're almost at stagnation on real work-based incomes, and the question will be, will the consumer adjust to that at a time when all these other components are already starting to contract? So, nothing here in the past couple of weeks or past couple of months has changed my view that we are either on track towards a classic NBER defined recession, or something very close to that that's going to widen the output gap, cause deflationary pressures to come into the system. And either way, no matter whether the Fed does 25 or 50 in the next meeting, the path is going to be towards zero over the next 12 months as far as I'm concerned.
And then on the earnings side, Nancy, you mentioned this is all, margin, it could compress margins, hurt corporate confidence. If you look at where the pain is today, it's pretty widespread. But technology down 3%, hardest hit group, energy, consumer discretionary. I mean, which groups get downgraded the most in terms of earnings expectations as the trade war just gets worse and more prolonged?
Yeah, so I mean, David brings up a good point about the consumer, but I actually think they're in great shape. So the consumer discretionary stocks may actually be one of the places where you can hide, though you have to be selective. In this environment, I worry about the chip stocks, the transportation stocks, and overall industrials, because if the slowdown gets worse and impacts the U.S. more, then those are the companies that are going to be most exposed to
so
earnings.
It's the classic
declines.
China trade playbook.
I mean, it is, yeah.
Yeah, and I mean, Dave, the message from Powell today, just to get more specific about it and his posture right now and how the Fed is treating these things, saying act as appropriate. Well, in the last several hours, maybe more action seems more appropriate. So where are we with regard to market expectations and how the Fed might meet them or not?
Well, look, I think Powell, it could be considered to be a dove as far as I'm concerned. But at the same time, he's only got one vote on the FOMC. He doesn't have 10 votes. Now, he might have the most important vote, but we know that we have a very divided Fed. With or without what happened today, we know that this trade war, I mean, anybody who thought this trade war was going to end soon, I actually saw somebody, I guess this morning on Squawk Box, saying that they were expecting a trade truce. I think that's just totally fallacious. This is, I guess, today an exclamation mark that this trade war is going to continue. But I think most people had that view anyways, that this was not going to be easy in terms of getting a trade deal done. You have people on the Fed that are very hawkish. You have people in the Fed that actually have this view that unemployment's very low, consumers great, the domestic economy is in great shape. The U.S. is this island of prosperity. We'll keep an eye on the overseas developments. But you have a lot of people on the Fed that don't want to cut rates. Not just a couple, a lot. In those FOMC minutes, it was very clear that you have, I think, the most divided Fed that I've seen in my 30-plus years in the financial business. So Powell's hands are really tied. I think they will continue to cut interest rates, but I think that they're going to be going slow-mo. They won't be going 50. I think they probably should, in my opinion. But that's based on my economic forecast. But they'll continue to cut interest rates, and only something, if you start printing negative payrolls, or we start seeing negative prints on U.S. consumer spending, well, then they're going to get a lot more aggressive. But I think that the bar is high right now, considering how divided the Fed is, for them to move aggressively, I'd say, over the course of the next couple of months.
And now we have this yield curve inversion again. You know, it's happened multiple times over the last week or so, David. I've got to say, more people come on CNBC and say it's distorted. It's foreign investors that are just searching for yield, and the U.S. is the only place that they can get it. It's the ECB, it's the BOJ. There's so many factors that make it different this time. What say you?
Well, I think that for people out there that manage money for a living, you have to know that when everybody's focused on the shape of the yield curve, you know that it's not important, okay? It's not about the shape of the yield curve. You do not need to have an inverted yield curve to have a recession, okay? So I think this obsession with the yield curve is totally misplaced. What people should be focused on is the meltdown in the yield curve. The whole general structure of interest rates has melted in the past 9 months. And there's valuable information in that meltdown in interest rates. People say, well, who wants to buy bonds at these levels? They're so expensive. No. That's not the story about whether you want to buy bonds or not. There's a powerful message if you're managing assets in this environment. The meltdown in interest rates is telling you that we've had a collapse in global investment to a point where investment has fallen below the level of global savings. So interest rates have moved lower to equilibrate this investment shortfall. And I cannot believe that people, economists in particular, aren't coming on to talk about why are interest rates so low and why have they fallen from already egregiously low levels last year to where they are today. It's not about the yield curve. It's about this dramatic move down. And it's a very powerful message. That move down, by the way, not the shape of the yield curve, the move down, especially in real interest rates, carries with it a very ominous message for economic growth over the course of the next year. So I say ignore the yield curve and focus on what the whole maturity structure is telling you.
And they are pretty much at their recent lows. The 30-year Treasury 202 and some change right now, and the 10-year at 152 or so. David, we will leave it there. Thanks a lot.
Thank you.
Rosenberg. All right, well, the dollar index also taking a leg lower today following the president's tweets. Sarah has a look at what is behind the move, Sarah.
Yeah, this was a pretty sharp move, and not just stocks. Some big moves in currencies, creating ripple effects across markets. The currency market is now on high alert this afternoon for potential intervention. So check this out. This is what happened to the dollar today. Earlier in the morning, you can see around 10 a.m., it was kind of an indecisive reaction to Powell. You got a little bit of dollar weakness on the notion that the Fed could keep cutting interest rates. That was sort of what the market did want to hear. But then it really started taking a leg lower after this, the president's tweet. As usual, he says the Fed did nothing. It is incredible that they can speak without knowing or asking what I am doing, which will be announced shortly. We have a very strong dollar and a very weak Fed. I will work brilliantly with both, and the U.S. will do great. So what did he mean, what I am doing, which will be announced very shortly? And then following up with about the strong dollar. Well, we know he has this fixation, and he has had it for weeks now with the strong dollar. So the bets started piling up that he might actually go through with directing the U.S. Treasury to step into the market to weaken the dollar. The dollar did weaken in anticipation of such a move. It would be extraordinary for so many reasons. For one, it hasn't happened since the 90s. It did happen back in 2011 with the U.S. and other G7 partners. They intervened to weaken the yen because it got so strong after the devastating earthquake and tsunami. And the reason it doesn't happen? Because it generally does not work unilaterally. Famously, remember the Bank of England, Black Wednesday, speculators broke the British pound and the central bank. If the market views the fundamentals right now point to a stronger dollar, guys, usually the market wins. The Treasury does have a fund for this, $21 billion, an extra $50 billion in IMF currency, but in foreign exchange, $5 trillion trades every single day. So we're on alert. I mean, we'd likely see a statement from the Treasury that they direct the New York Fed to step into the market. It would be very interventionist, very unconventional, and by the way, majorly frowned on tonight. President Trump goes to G7 where countries for years have been saying, we're not going to intervene in the currency market. We're going to let our currencies float freely.
Yep, that's been the standard line for everyone for a long time now. You know, Sarah, it's also interesting to try and divine what's behind the move beyond just the Fed maybe dovishness and also this idea about intervention, because normally when we got the escalating trade tensions, you see a dollar rally. So there's all kinds of opposing currents that are going on.
I mean, the gut take is you don't want to be on the other side if the Fed does step in to intervene in the currency market, even if it doesn't ultimately work. I mean, that's a risk you don't want out there. The other thing I would just note is I think it's going to be a tricky decision for the administration because they just accused China of being a currency manipulator.
Right.
China's currency, if you're watching it, it's actually one of the currencies that's weaker than the dollar today on this idea that more tariffs hurt China, and that's really why its currency is weakening. So if the U.S. were to turn around and actually step into the market, it would look pretty hypocritical.
I also wonder, given the dollar has been rallying, whether it's a general, look, speculators are long a lot of stuff, and today you're reversing a lot of trades in general. So I don't know how to interpret all of it, but
which would argue
the idea of intervention has.
Yeah, and it would you could argue it kind of worked today. You know, the tweet got people to do
job owning.
Yeah.
Certainly. I mean, how strong is your sense of the dollar right now as it relates to the damage it's doing on earnings and the economy?
We're not hearing it or I should say we didn't really hear it on the earnings calls. I think companies have made the adjustment. They are expecting the currency to weaken some in the second half of the year. We may not get that. But I don't think it's been debilitating to multinational earnings, although you've seen the same numbers I have. Multinational companies have not performed as well as domestically focused companies. But that's just a near-term issue. And I think as investors, we got to look a little more than one tweet out on a Friday afternoon.
Well, the Dow now trading lower by 562 points. The S&P down 67 at this point. We do have about 38 minutes left to the close. For more on this whole picture, let's bring in Mohamed El-Erian. He's former PIMCO CEO and now Allianz Chief Economic Advisor. Mohamed, great to talk to you. Frame the conversation for us a little bit here. We already had markets that were on alert for a deeper slowdown in global growth, wondering if central banks had the ammunition and the will to counteract some of those effects, and now a ramping up of more of these trade frictions. Where does that bring you?
So you're absolutely right. We've had this balance for the last year. On the one hand, weakening fundamentals, especially in Europe and in Asia. On the other hand, confidence that ample and predictable central bank liquidity can insulate markets from the effects of that, plus technicals that on the whole have been positive. And what you're seeing today is both sides of that equation going against investors. There is a further weakening of fundamentals. And remember, the escalation of trade wars, and you've heard me say this over and over again, we're going to have more escalation. That's what all the bottom-up tell you. The escalation of a trade war increases the probability of a currency war. So fundamentals worsen today. And on the other hand, Chairman Powell admitted what a lot of people already knew, but it's good to hear it from the Fed, that he can't counter this trade uncertainty. So the market looked at both sides of the equation turning against it and sold off in a very broad fashion.
Yeah. So, I mean, if you add it all up, Mohamed, it equals slower global growth, which we know has already been a problem, right? The trickier question is, what does it mean for U.S. growth?
Yeah, and the even trickier question is there is a difference between what it means for U.S. growth and what it means for U.S. markets. So it is a headwind for the U.S. I don't think it's a strong enough headwind to tip us into recession for the reasons that you've heard earlier, which is the non-tradable sector, the service sector is still quite large, and consumers and the labor markets are in a good place. So it slows us. That's no doubt about that, but it doesn't tip us into recession. But markets are much more exposed to what happens to the rest of the world. So you're going to get a decoupling of markets. And what we all have to think about is the feedback mechanism from markets to the economy, the self-fulfilling expectations. That is where the danger is for the economy.
At this point, are you particularly worried about that? Where are we? Off from the highs, 5.7% from all-time highs on the S&P.
Yeah, I mean, markets could go lower, undoubtedly, and I think that you have to think in terms of three strategies than simply buying the dip. One is look for areas of particular dislocation, and there's more of them, by the way, outside the U.S. than in the U.S. Secondly, look for where there is an interruption in the supply chain, in credit in particular, because that's happening. And then thirdly, look for names that haven't been the sweetheart of recent rallies, but have these characteristics of being protected because they serve mainly a domestic audience. That is the strategy. It's very selective, and then wait before you increase the general exposures to the market.
Mohammed, you say you are seeing examples of dislocation in the credit markets right now. Is that here? Is that globally? Where?
Yeah, I mean, look at Turkey. Banks have stopped lending, and if you're able to construct private credit with a lot of collateral, you're getting paid a ton of money for mostly hedged risks, especially if the assets are held abroad. You have the same dynamics in a number of other countries. You're going to see high-yield companies in the U.S. now finding access to markets harder. So you want to pick your spot, and you want to focus on the dislocations, which is different from the strategy that has worked so well for the last few years, which is buy every dip, because we have so much confidence in ample and predictable liquidity with pressing volatility. I think that confidence is being eroded.
Mohammed, always great to talk to you, especially on a day like today. Appreciate you calling in.
Thank you.
Thank you.
Voice of reason.
Well, Bank of England Governor Mark Carney making some comments in Jackson Hole just moments ago. Let's get back to Steve Leisman out there with some details. Hi, Steve.
Yeah, thanks very much, Mark Carney. Hope Sarah's sitting down because he is calling for the creation of a new virtual currency that could ease the reliance of the world on the U.S. dollar, which he says creates some of the problems that we have today. I can explain more of that in a second. He also says the UK outlook, hinges critically on Brexit. Sarah, he is pointing out that, for example, half of all international trade is priced in dollars, but the U.S. that's 5 times greater than the U.S. contribution to world output, along with 2/3 of world securities priced in dollars. And he says the problem there is that U.S. interest rate policy, U.S. exchange rate policy becomes exported to other parts of the world. And he says that is not the optimal way to run things. He acknowledges a long way off, but it's a pretty radical
Where did that come from,
proposal
Steve? Is
from
he
a
trying
guy
to get kicked out of Jackson Hole?
No, but I think what he's dealing with, Sarah, is this idea of why are we having so many problems related to the U.S. being strong but the rest of the world being weak? And he says that's because so much of the world is priced in dollars. So the theory of flexible exchange rates resolving these imbalances is not working. You know, Sarah, this is not the first time this idea has been talked about or floated. There's the special drawing rights from the IMF. But anyway, all these questions that you may have, and I have still, we're going to get a chance to talk to Mark Carney about this issue and others, including the outlook for the UK, potential spillovers to the US, as well as the rest of the world and emerging markets. So we're going to talk to him at 5:30 today. And just before that, we'll get a chance to maybe ask Rich Cloward, the Vice Chairman of the Fed, about this as well.
Yes, it seems very confusing. I mean, as if these guys didn't have enough challenges on their plate on traditional central banking. They're going to deal with the digital currency. I mean, making monetary policy with that seems hard.
I mean, I think what he might be getting at here is this idea that the U.S. is affecting the world beyond the amount which the world should be affected. And that's why, you know, Sarah, I know former traders in Russia that sit there and watch the U.S. employment report for how Russian stocks are going to trade. And the question I think Carney's asking is that right? Or should there be a different weighting of the importance of the U.S. economy on the rest of the world?
Really looking forward to your interviews, Steve. Thank you. Half hour
Thanks,
till the close. And we've got a big market sell-off on our hands. Dow down almost 600 points. Let's take a look at the companies with heavy exposure to China, which are getting particularly hard hit today. Rahel Solomon back at headquarters with a look at those names. Rahel.
Hi, Sarah. You can really see that sell-off reflected. Take a look in our CNBC China Trade Index. So this tracks companies with the most revenue exposure and most imports from China. It's down 3% now, falling sharply after the president's tweet. So let's start with Apple, which has about 20% exposure to China. It's down more than 4%, 4.3% at this point. Now, reports have suggested that Apple is trying to figure out how to move some of their production out of China and into India. CEO Tim Cook, however, tells CNBC they have made no significant changes to their supply chain. And it seems that Apple's problems are Best Buy's problems, because UBS estimates that roughly 15 to 20% of Best Buy's total sales are Apple products. Their stock plunged after the president's comments. Right now, they're down more than 3%. So they report Q2 earnings next week. We expect to hear a lot more about this then. And finally, there is heavy equipment maker John Deere, which has about 9% exposure to China, also down on the news, down right now almost 5%, 4.86%. So after all of this, where can investors find safety? We pulled a list of companies in the S&P 500 that have no revenue exposure in China and actually generate 100% of their sales in the U.S., and there are a number of consumer staples and utility stocks, but also some retailers like Dollar General and some healthcare names, including CVS, Centene, and Anthem. Anthem especially holding up relatively well today amid the broader sell-off, right now up fractionally, less than 1%. Guys, I'll send it back to you.
Rahel, thank you. New session lows here, down 600. Nancy, is that the strategy an investor should be taking right now? Look for domestic exposure only versus a name like Apple, which is down 4.4%, but still up, but almost 30% for the year.
I think you have to take a balanced approach. I mean, we are looking at the exposure our companies have internationally, but that doesn't keep us from owning them if the valuation's there. I think valuation ultimately trumps source of revenue. So if you look at some of the consumer staples and the utilities, they're trading at pretty lofty multiples. And so we go in and look and say, hey, where are there other places where we can find attractive valuations that have all the right elements, great management's growth, whether it's from globally or not. And still yet, even though we have high multinational exposure, we have a lot of companies that are focused primarily on U.S. revenues, source of revenues.
Is Apple in your portfolio?
We actually own Apple. Yep, we sold some a couple weeks ago at about a little higher than now and not as high as it's been recently, just because we got to keep trimming it back. But I don't think you run from that stock here.
28 minutes left of trade. Mike, over at the Telestrator, what are you watching?
Watching the S&P 500, in particular, putting it in some context in terms of how these declines fit into the longer-term picture. We have really been still in a trading range in August, and so this is a 2-year chart. So it's a pretty wide view, but it captures this entire long trading range. One thing we did today is we went back again below that level from January of 2018, which was a very, very dramatic peak for the short term, and we've been knocking around above and below it, mostly below it for a while right now. But this right here, if you took a shorter term view, that's the area we're looking at. We're still about 1% on the S&P above the lows from just last week. So it's not as if you've really exceeded the damage that was already done on this little move lower. I did want to take a look for this week. That tight correlation between the S&P 500 and Treasury yields. Look at this on a kind of a real-time basis, and it's interesting because the S&P 500 here in white, you see it was trying to create some separation as Treasury yields came off their lows, and then today we're right back in that fix where basically the bond market pulls the stock market around, especially today when you did get this move down to about 151. We're really slicing this really thinly right now, talking about basis points and ticks and whether the curve is inverted or not. But directionally, this is what matters. When yields go down toward their lows of this move, the stock market has a hard time resisting it, guys.
What are the key levels we're watching, both on the S&P and the
S&P? It's around 2820 would be the lows for August, just about there. Below that, I mean, look, we're not even back to where we got in the pullback in May. Right, so it's not as if we're cutting into muscle with this pullback. It's just obviously there've been a couple of false starts in terms of moves back to new highs.
I mean, it puts it in perspective, Nancy. It just feels on days like this.
Yeah,
painful,
it
right,
does. But if you look at the year-to-date returns for the markets, it's a good year so far on a year-to-date basis. But if you look at the trailing two, as Mike's discussing, I mean, it's been a lot of effort and a lot of volatility to not get very far. But that's what the market does. Go back to 2000 to 2003. You did nothing for 3 years, and then you had a nice run. And then, of course, the big correction.
So here's a check on the biggest losers in the Dow today, and there are no shortage of them. 29 out of 30 Dow stocks lower. Apple's getting hit the hardest. It's shaving the most points off the Dow as well, 60 points off the Dow. Goldman Sachs and 3M also taking more points off. But there you see it's mostly China exposed and companies that have global footprints. Nike, Intel,
Boeing.
American Express, IBM. Boeing is the only winner right now in the Dow. There's a report out of the Seattle Times that the 737 MAX may be moving closer toward approval. That has helped Boeing yesterday and today. It's only adding about 12 points to the Dow right now. We're down almost 600, and we've got about 25 minutes left to go here. Here are the major things that are driving the action right now. The president lashing out at China and Fed Chair Jay Powell after China promises its own set of new tariffs this morning. Powell did speak today, declined to signal significantly more easy monetary policy. And this whole turmoil is reigniting fears of recession as the yield curve inverts yet again.
All right, we have just under 25 minutes left to go. We've got full team coverage of the market sell-off and President Trump's order for American companies to immediately start looking for alternatives to China. Morgan Brennan has how that's impacting transports. Courtney Reagan is watching retail, and Seema Modi has industrials. So, Morgan, let's start with you.
Hey, Mike. So Dow Transport's plunging right now, down something like 3%. Every component is lower. Parcel carriers, railroads, truckers, passenger airlines. Basically, these are the companies that are on the front lines of trade, moving goods and people, and thus seen as gauges of global economic growth. The Cass Freight Index, which is closely watched by Wall Street, showing an almost 6% drop in shipments last month, saying, quote, the shipments index has gone from warning of a potential slowdown to signaling an economic contraction. Meantime, today, President Trump tweeting he's, quote, ordering all carriers, including FedEx, Amazon, UPS, and the Post Office, to search for and refuse deliveries of fentanyl from China or anywhere else. That, too, is in focus here with this group today. UPS and FedEx both responding to those tweets that they follow the laws and regulations everywhere they do business and that they're working closely with authorities. We did reach out to Amazon and the Postal Service. We have not gotten a response from them yet. But overall, the transports, again, really on the front lines of trade. So the ratcheting up of these tensions is where you're seeing that particularly play out in the market with all of these names and certainly pushing them even further into correction territory. The Dow transports are now down 13% over the past 12 months. Back over to you.
Morgan, thank you. New session lows here down 615 on the Dow. Let's get to Courtney Reagan for how retailers are being hit by the sell-off. Courtney.
Sarah, you know, the idea of tariffs has been brought up at least 166 times on retail earnings calls since the beginning of this year. By Refinitiv's count, we know that that's nowhere near the end of those numbers that we're going to see. You have to remember, of course, that for retail, China is very important in two ways, both for manufacturing product that ends up in the United States and elsewhere, and also as a market to generate revenue. So a statement from the National Retail Federation saying in part today that retailers have been diversifying their supply chains, but finding alternative sources is a costly and lengthy process that can take years. Our presence in China allows us to reach Chinese customers and develop overseas markets. So retailers with a decent amount of Chinese manufacturing that are under pressure today include names like Steve Madden and G3. They have a lot of branded products. American Eagle, Gap, and others, of course, are lower, but these are some of the worst. And then you think about the retailers that actually generate revenue in China by selling to Chinese consumers. Nike produces just about 10% of its goods in China, but generates 16% of its total sales there. Other retailers that count on revenues from China include Tiffany, Tapestry, Estee Lauder, Walmart, Abercrombie, and a number of others, but those at least are the names with a higher percentage of revenues coming from China. So retaliatory tariffs can hurt really bad there as well. Back over to you.
Courtney, thank you very much. We are now at new session lows. The Dow did get down even below this point of 609. It's just about 200 points, maybe a little more than that, above the lows from last week, but still session lows today, and that was the low for August as well last week, down about 25,394. Let's get over to Seema Modi for more on the industrials. Hi, Seema.
Hey, Michael, and I just want to share with you some new commentary from sell-side firm Stephens, which tracks the industrials, and they say for Caterpillar, a key bellwether, although only 5 to 10% of revenues are directly exposed to China, on an indirect basis, Cat's mining business is heavily exposed, and China does consume half of the world's iron, copper, and coal, and Cat generates roughly 20% of revenue from its resources industry business, which is largely mining. It's worth noting shares of Caterpillar are now down 12% this month, joining a handful of industrial giants that are also down double digits in August. And it coincides with new data that showcases weak U.S. and European manufacturing activity. But it's worth noting that there are pockets of strength within the broader industrial space. In fact, aerospace and defense has actually held up relatively well in comparison to the construction-related names. Lockheed Martin, by the way, hitting another 52-week high in today's trade. Guys?
Seema, thank you very much. Nancy, within the industrials, how do you play that sector right now? Seema talked a little bit of a divergence there.
Yeah. So we own some of those stocks, unfortunately. We also own some of the stocks that have outperformed, like Boeing, and you could argue UTX. We reduced our exposure to 3M after the first earnings miss, but we still own it. As a portfolio manager, you've got to have exposure to some of these names because you've got to have some sector exposure no matter what. But it's been difficult. We sold out of Emerson not all that long ago, and it's a long-term game, and it's all about what you weight in the portfolio. I'm very disappointed with FedEx's performance.
I was going to mention FedEx.
It's a stock we own. It's a company that has stumbled a few times, but still has the potential to be dominant in its space. UPS has actually done better this year. We also own that in a different strategy. But FedEx should be the leader in this environment and should be able to weather the storm in a much more muted fashion. It goes down more than the market and goes up less over the last 12
pretty
months.
close to its 52-week low, actually,
it's just
with
been
today's
terrible.
decline. And I mean, obviously, one thing the president mentioned outright was that he was perhaps suggesting some kind of a new burden on FedEx and other shippers to make sure there's no fentanyl in the package.
I think he was ordering
who knows what's
them.
going to happen,
Right.
But the point within that kind of news flow to feel like these folks are in command of their own destiny.
And it's a company that did all the right things, right? I mean, they technologically just transformed their logistics, the logistics of their business, and yet there's been no realization of that in the earnings or in the stock price.
Yeah. All right, we have the Dow down 613 still. Treasury yields also hitting their lows for the day with about 19 minutes left. Oil also feeling some pain today after those China tariffs included a 5% levy on American oil. Those are the tariffs that were threatened now by China for later this year. Joining us now is Halima Croft, Global Head of Commodity Strategy at RBC Capital Markets. Halima, I see you're in Jackson Hole. Is this correct? So, how do you put this move in context with what we've already been seeing with oil on the defensive?
Yeah, I think it's really keeping with the trend we've seen all summer is the concerns about demand destruction. I mean, crude has been one of the principal casualties of the trade war. So I think the real concern is that we're not going to get out of this trade war anytime soon, and that oil is going to have a weak demand outlook. Now, in terms of U.S. exports to China, those had already been falling off since the trade war had resumed. I mean, exports had only been averaging about 110,000 barrels a day. China can source those barrels from other countries, so it's not a really big story for the physical markets. I think it's more about what does this mean for demand. I don't think oil can really move higher as long as we have these real trade war fears.
So just elaborate on that last point about oil, because the Chinese are targeting it. How much of an export market is China for U.S. producers? How much does it hurt U.S. producers if those tariff rates go up and if Chinese buyers look elsewhere?
I mean, it is not a big U.S. market in terms of where we send our exports. The U.S. sends primarily exports to places like Canada, South Korea, India, the Netherlands. Now, back, a year ago, there had been a sense that this could be a potentially big market. It had been a sort of bright spot in the China-U.S. trade story. We were seeing increased U.S. shipments to China last year. And there was a sense that China was looking to the United States as part of its broader energy security, getting less barrels from the Middle East, getting more barrels in places like the United States. But again, since the trade war has really commenced again, China's been sourcing barrels from other places. China's been sourcing barrels from Saudi Arabia, from Russia, from Angola, from Brazil. They've also had to make up for the lost Iranian barrels. So if you want to talk about what's been a really big disruptive story for the Chinese market, I would actually say it was the loss of barrels from Iran to China that was a bigger story in terms of China's physical market for barrels.
Given all that, Halima, I mean, I guess I could almost kind of turn it the other way and say, is it notable that WTI remains where it is, above $50? And in other words, it's not a more dramatic sell-off, at least in the short term.
I mean, I think right now, it is reflecting the fact that, this isn't a huge market for the actual product. But I think the question is going to be where we go through the end of the year is we have a very important OPEC meeting coming up in a couple weeks' time. We're going to really have to see how this producer cartel organization really responds to this weakened demand outlook picture. I mean, do we see OPEC step